Oh, aloha everyone. Joshua Hayes at bigwavetrading.com. The strange summer continues as I kind of expected this market to immediately start selling off this week on Monday and just hopefully, if you want everything to line up properly seasonally, continue throughout the rest of the week. Instead, as you can see here, the S&P 500 rallied almost 0.5% today. The Dow Jones Industrial Average is up slightly, about 0.20%. The Nasdaq gained 0.61% and the Russell 2000 gained 0.56%. However, if you look at the S&P 500 here, you'll notice we're hitting new short-term highs. What's our volume doing? Okay, so keep that in mind. New York Stock Exchange, see the same thing. The SPY, comical, very comical. Dow Jones Industrial Average, at least it was heavier today, but significantly below average. And the DIA, once again, comical situation happening here. Now, the good news is that the Nasdaq rallied on above average, heavier volume, so that's good. But overall, if you go look internally, you'll see the RSI and MACD price oscillators are not keeping up with price. So there's negative divergence internally in there. On top of that, the Russell 2000 continues to lag overall. The IWM, while up today, did so on lower volume, and you can see the BOP indicator is also going the other way. So overall, trending higher. It's fine. It's summer. It's choppy. I thought maybe we could sell off and then hopefully find a floor to rally off of with oversold conditions coming, with bearishness increasing as we try to move on through poor seasonality. But it looks like the market's going to try to drive everyone crazy if you're bullish or bearish. Now me, I've been around a long time. I know what I'm dealing with. It's summertime. I try not to look too much into it, but it's still unfortunate that things aren't quite working out the way that I was hoping things would work out within the market. And then on top of that, trading wise, everything's not working either. The SPY puts that I put on last week expecting this turn lower in seasonality, I'm already out half of it. Let's actually go look at the intraday trades today. You can see that all the limit orders filled in the morning, and as you can see, as the day went along, extremely orderly. Fantastic open, very few stops triggered at the open, and then as the day went along, even less triggered. So it was pretty perfect, except for we see an immediate new long position immediately trigger a sell stop, a recent long position fail, and then of course right here you see me getting out of half of those SPY puts that I put on. So not everything's working. So with that being said, status quo continues. Trade cautiously, tread cautiously, and just be very careful. We still have to get through August. We just started August. This is a very bad month for stock market returns, and then that leads us into September, which is even worse. It's actually the worst month for stock market returns. So I don't know why everybody's so excited that the market is actually moving up here. You technically really don't want it to do that. Now, if our long positions move up here, great. That's positive divergence. But if you want a chance at a more powerful, better rally in the fourth quarter of this year with better chart patterns where you can put more confidence and conviction behind the trades, it's not necessarily what you want to see happening. But it is what it is. Don't look too much into it. Just remember, all low volume V-shaped rallies end the same way. Some end pretty harshly, some don't, but they still always end the same way. Heavier volume distribution whenever they do end. But with that being said, not going to let my, bias towards the direction that I think the market's going to go influence the actual signals that I received. And on that end, we got 3 long signals. But before I go through those, let me just really quick just pop off the full sell signals and the partial sell signals. BLPH, that's 100%. 3 lower highs, 3 lower lows, below the 50, below the signal date, low a day. Heavier volume, above average volume, I should say. That's a final cut loss signal. NOG didn't move higher immediately, but still holding above these 2 supports with green BOP. So that's a half end of day sell signal. SKF closing below this recent low is a 50% sell signal. OPRX is closing below its 20-day moving average on above average volume, 50% sell signal. I was completely shaken out of all of it on Friday for what it's worth. AGM, 50% sell signal. I no longer have a position in AGM. I believe I was completely knocked out of all of it back here in February, still trekking on an end-of-day basis because of that reversal bar. And then AAXN, never got a position. Was fully invested. Remember, I was maxed out with capital here and had too many other good looking charts, so I never took AAXN, and it continued to drift higher. Never bought it on the pullback. Good thing, I guess. 50% sell signal with it closing below the 50-day moving average on above average volume. So now that leads us to our 3 new long positions. They're not great. They're just good enough. You got HUD, CYBE, and BY. So HUD, this was initially flagged in my IPO scan. I go do a little bit further research on it. I see it's canceling quality with its earnings and sales growth. It's obviously an earnings winner, and it also showed itself in my price volume BOP surge scan. Normally this would be a 2% of my account capital long position, but sadly it's extended from its short-term moving averages, and since the market is what it is, no need to push things here. So 1% of my account capital into HUD. Limit order 18.99. First cut loss, today's low a day, 1 cent below it, 18.40. The next cut loss 18, and then my final cut loss on this position, I just can't stand when that happens, is going to be 17.61. Right there, the gap fill. I got to move my cursor so that box doesn't pop up, but right there, the gap fill will be my final cut loss for now. Now, if it loses its green BOP before it gets to that gap fill, obviously the gap fill low a day will never come into play. But HUD, normally 2%, and in a stronger market, who knows what it would be. I haven't even thought about increasing the size per long position since February. It's insane, but that's what we have. So 1% of my account capital. And then CYBE. CYBE, candle over candle, hammer over hammer, candle over candle price bar. Above average, heavier volume, back-to-back pocket pivot point signals day in a row, and BOP surged nicely to a nice green level here. CYBE is pretty clear cut. Limit order, high day, 19.20. My one and only cut loss, today's low day, 18. You could use some of these levels if you want, but since none of these lows are yellow, much less green, that's it. I got one stop loss to work with. 19.20 entry, 18. And then the final new long position, BY. This showed up in my price volume BOP surge scan. I do a little bit further digging into it, and I see that it's not quite canceling quality, but the earnings and sales growth is above 25% each in the most recent quarter. Earnings and expectations for the upcoming year are pretty solid. So this is definitely a future canceling quality stock. Since it's just in the price volume BOP surge scan for now, it's just 1% of my account capital. Limit order 22.60. High day. First cut loss 22.20. Second cut loss was at 21.97. Final cut loss 21.90. If you go long BY, if you're a new investor, new trader, and you decide to take this long position, like I said, none of these signals are the greatest signals. I'm going to remind everybody. Do you see me placing 20% of my capital into each of these new positions? Do you see me placing 10% of my capital into each of these new positions? Do you see me placing 5% of my capital into each of these new positions? No. You see me placing 1%. That tells you the kind of quality that I believe these signals are within the quality of the overall market. Do not want to take them, because if this thing moves up 20% in 2 weeks without me, I'll want to kick myself in the behind for missing it. But for now, it's safe to say that it's worth the risk for the potential reward based on measured moves of the previous uptrends, which is what I'm always looking at. So BY, you can see when it moves good. CYBE, when it moves, you see it can move pretty good. And even though HUD is an IPO, you can see it moves really well whenever it decides to move. And with that low inherent risk, these are trades that I simply have to take. But overall, for HUD, it's pretty safe as long as you use these two cut loss levels. So if you feel like you have to trade here, you know, you could have worse selections this evening. With CYBE, same thing, just using the regular lows. And with BY, you could use all three stops. So all three are relatively, quote, quote, air quote, safe. But in this market, nothing's really safe. And in any tape, nothing's safe unless you have complete confirmation and all of the indexes moving higher on higher volume. When you do not, you have to understand on an end-of-day basis, it's always going to be risky. Keep that in mind.